So now we're just looking at monetary, and we're trying to decide if it is contractionary monetary policy or expansionary monetary policy. If it is contractionary, we are trying to fight inflation. And the way that we do that is by decreasing aggregate demand, which decreases GDP and decreases the price level. If it's expansionary, we're fighting unemployment. We're trying to get out of a recession. So if it's expansionary, we're fighting unemployment. And our goal is to increase aggregate demand, increase GDP, and increase the price level. So if we're fighting inflation, it's contractionary. If we're fighting unemployment, it's expansionary. If the Federal Reserve sells bonds, that means that they are giving people cash. They are giving people bonds in exchange for cash, which will decrease the money supply. And if they're decreasing the money supply, it is contractionary. If we raise the reserve requirement, that means that banks will be able to make less loans, so we're decreasing the money supply, and it's contractionary. If we decrease interest on reserves, then there is less incentive to keep your money, or less incentive for banks to hold excess reserves, meaning that the money supply will increase as banks make more loans, and it's expansionary. If we raise the discount rate, remember that the discount rate is the rate that banks are being charged for those overnight loans from the Federal Reserve. So if they raise it, that means that the punishment for having to go to them is essentially higher, meaning that banks are going to make less loans. So this will lower the money supply, and it's contractionary. If we're lowering the money supply in some other way, it's contractionary. If we lower the reserve requirement, this means that banks have to keep less money on hand, meaning that the money supply will increase, and it's expansionary. If they increase interest on reserves, this means that banks will have a larger incentive to have extra reserves on hand, so this will decrease the money supply, meaning it's contractionary. If they lower the discount rate, the punishment or fine, essentially, for having to go to the Fed and need a last-minute loan is lower, increasing the money supply, which means that it's expansionary. If they're buying bonds, that means that they are going to the people and they are giving the people cash in exchange for the bonds, meaning that there's more money in circulation, so the money supply is increasing, and it's expansionary. If they're increasing the money supply in some other way, it's expansionary. Contractionary sounds like it's getting smaller, so the money supply is in fact decreasing. Expansionary, something is getting bigger. It's not the economy, it's the money supply.